Hey, what it do, Diddy Bloods? Let's get into lesson 3, cost, revenue, and profit. Let's dive right in, baby. So by the end of the lesson, you'll understand the key terms involved. You'll understand how to do calculations, interpretations, make decisions, evaluate. Bam, bam, bam. Let's keep the gravy train rolling. We got the key terms: fixed cost, variable cost, total cost, direct cost, indirect cost, average cost. We got cost on cost on costs. That's okay. I'm going to make it simple for you. Let's go ahead and move forward. First, we have fixed, variable, and total costs. So fixed costs, these are things that do not change depending on the amount of output that you have. So let's say that you own a factory, right? An example would be that you have to pay rent to the owner of the facility or the warehouse that you're using to manufacture and store your items. That's a fixed cost. It doesn't change from month to month. Now we have variable costs. These are things that do change depending on the output. These are things like utilities, hourly wages, the cost of raw materials. If you produce more items, let's say that you're producing desks, right? If you're going to produce a desk, you need things like wood, some metal, right, for the legs. You need all these raw materials. So if you're going to produce 5 desks, you need much less raw materials than if you're going to produce 5,000, obviously. So your costs are going to go up in terms of raw materials, but that's okay because in theory, you should be making more money. The same goes for utilities and hourly wages. If you're producing more, if you're using your machinery more, that's going to take more electricity. If you have your employees working more because you're producing more, then the hourly wages are going to increase because they're working more hours. So these variable costs are just things that change depending on the level of output. And then we have the total cost. And this is simple. It's just the sum of the fixed cost and the variable cost. So let's take a closer look at this graph here on the right. Take a look. Now, if you look here, you'll see your fixed costs start right here. And notice that they don't start at 0. That's because even if you produce 0 units, you still got to pay the landlord, baby. He doesn't care. He just wants his money. So it doesn't matter if you produced 0 things, you still have to pay that cost. Now, take a look here. Your variable costs do start at 0. If you produce 0 units of something, you had, in theory, 0 raw material costs, 0 labor costs, because you didn't produce anything. You didn't make anything. Now, as you start to produce more, look here at the units of output. As you start to produce more, let's say 10,000 units, well, now your costs are going up, right? 20 units, your costs are going up. 30 units, because you have to buy more materials. You have to pay more workers, right? It goes up, it goes up. Look here, you'll notice something. Total costs starts where fixed costs start because that's included in the total costs. Remember, the variable cost and the fixed costs added together make the total costs. So your total cost starts here, logically, because no matter what, you have to pay that. And then you can add up the sum of these 2 points and you get this. So look here, we have 300 plus 800 gives us 1,100. So that's our total cost. And you can do that for any point on the graph. So it's a pretty easy concept to understand. Just keep in mind, total costs are variable costs plus fixed costs. And of course, I will have this cheat sheet uploaded with this lesson, either in the description or as some sort of attachment. So don't worry if you need to review this. Now, let's move on to direct and indirect costs. So what are these? Let's start with the direct costs. These are costs that can be clearly linked to the production of a specific product or service. For example, the raw materials needed to build the desks that we were talking about, the packaging, the shipping, the direct labor cost, paying people to make the desks. These are directly related to your business's activity. So now we have indirect costs. These are costs that cannot be directly linked to one specific product and are shared across the business. These are things like utilities, office supplies, depreciation, rent. So you still have to pay for utilities, but it's not related to making desks, right? I mean, that's not your core product. You're not selling electricity, so it's an indirect cost. Take a look here. We have one more example. What's the difference between these two? Direct costs are involved directly with the business activity. For example, a construction company needs materials to build. These are directly related to the business. They need those materials to build the building. So that makes it a direct cost. However, construction companies also need to pay for paper and printer ink to print contracts. These are considered indirect costs because they're not related to construction, but are still needed and cost money. Anytime that you build a building, you're going to have a contract on paper. I mean, even in the least developed countries in the world, you're going to have a contract anytime you build a building. So that's an indirect cost. They still have to pay for the lawyer usually to write up those contracts. They have to pay for the printer ink, the utilities to power that printer, so these are indirect costs. Now we're moving on to average costs. So the definition of average cost is total cost per unit of output calculated by dividing total cost by output. So this is the formula. Total cost divided by quantity produced. That's the formula. It's that simple. So take a look at this example. The total costs were $20,000. With that $20,000, 100,000 units were produced. So let's put it in the formula. Total costs, $20,000 divided by 100,000, because that's the amount of units, equals 0.2. So 20 cents per unit. That's your average cost, 20 cents per unit. It's that simple, baby. Now let's talk about revenue. Revenue is the income a business receives from selling goods and services. And of course, the total revenue is the total income from sales calculated as price times quantity sold. So if you're selling something for $5 and you sell 10 of them, your total revenue was $50. It's that simple. Now, something that I really need to talk to you about, this is a common mistake that students make, is the difference between revenue and profit. So let's be clear. Revenue is the money you make. Profit is the money you keep. Just because you make $5,000 doesn't mean you're going to keep $5,000. You have to pay your employees. You have to pay for your direct costs, your indirect costs, right? So you're not going to keep all the money that you make. That's logical. So now let's calculate average revenue. It's the same principle as average cost. So it's total revenue divided by quantity sold. So let's say you made $100,000 in revenue and you sold 50,000 units. What is your average revenue? I'll give you a second. Yeah, it's $2. Your average revenue is $2. Okay, it's because it's 100,000 divided by 50,000. 100 divided by 50, that's 2. So now we're moving on to profit. We have gross profit, operating profit, net profit. Now, it's really important to understand the difference between these things. So gross profit is revenue minus the direct cost of sales, cost of goods sold. Also, you will see this as COGS, cost of goods sold. COGS. Operating profit, this is the gross profit minus operating expenses. We're going to take a look at what operating expenses are, don't worry. Now, net profit, you may also see this written as profit for the year. This is the profit remaining after all costs have been deducted, including interest payments and tax. Let's go ahead and take a look at each of these here. So, gross profit, it's revenue minus the cost of goods sold, COGS. So here's an example for you. Let's say your total revenue was $100,000 and your cost of goods sold was $60,000. So we subtract 60,000 from 100,000 and get 40,000. Pretty simple. Now, for your operating profit, it's the gross profit minus operating expenses. Now, operating expenses are things that you need in order to operate your business. These are things like rent, staff wages, marketing. So what you do is you add all those operating expenses up. In this case, they add up to 30,000. So you take the gross profit and you subtract the operating expenses. That leaves us with $10,000 for operating profit. Now on to net profit. This is the profit remaining after all costs have been deducted, including interest payments and tax. So let's keep going with the same example. Let's say that your interest and tax was $5,000. So let's take the operating profit. That's $10,000 minus $5,000. That means your net profit was $5,000. $5,000 from $100,000. It's just an example, but that ain't great. Now let's talk about profit margins. This is a super simple concept that many students overcomplicate. So a margin is basically a percentage. So the percentage of revenue that remains as profit after costs have been deducted, that is a profit margin. Now, there are three kinds of profit margins. Here, gross profit margin, that is gross profit divided by revenue times 100 to get a percentage. Anytime that you're wanting to show something as a percentage, you're likely going to multiply by 100. So take a look here. $40,000 over $100,000. Because remember the example. Our cost of goods sold were $60,000. That left us with $40,000 of gross profit. It's gross profit over revenue times 100. $40,000 over $100,000. That gives us 0.4 times 100. Our gross profit margin is 40%. So now let's take a look at the operating profit margin. This is the operating profit over revenue times 100. It's the same principle. Notice, only the numerator is changing depending on the margin that we're calculating for. So in our example, we had $10,000 in operating profit divided by $100,000 in revenue. That gives us 0.1 times 100. That's 10%. Our operating profit margin was 10%. Now, moving on, net profit margin. The net profit margin follows the same principle. Net profit over revenue. Notice, the only thing changing is the numerator. You don't have to memorize 3 formulae. You really only have to memorize 1. You just have to change the numerator. So in our example, our net profit was $5,000 over $100,000 in revenue. That gives us 0.05 times 100, 5%. Our net profit margin was 5%. So let's take a look at a past paper question here. This is from October, November of 2022, and it is paper 1. It says, define the term gross profit margin for 2 marks. So we just have to define it, nothing else. So take a look at the answers in the mark scheme. A profitability ratio that compares gross profit, profit before deductions of overheads, with revenue. Or if you want to get full points, you could also just give the formula, gross profit over total revenue times 100. There you go. It's that simple. You don't need to write a whole paragraph and waste a bunch of your time and energy. That's not necessary. So let's take a look at another question. This one is from paper 2, and it appeared in October, November of 2021. So it says, explain one possible problem for AB of trying to allocate indirect costs. Here, if you want, you can pause and read the whole thing. I'm not going to read it out because it's not of great importance for what we're doing right now, but if you want to, you can. So here on the mark scheme, you'll see that it has knowledge and application. So they're testing AO1 and AO2. So for full marks, you have to give an explanation of one possible problem for allocating indirect costs in context. So take a look here at the ideal answer. One possible problem for AB of trying to allocate indirect costs is that overheads such as rent, electricity, and administration costs cannot be linked directly to one specific product or department. This makes it difficult to divide these costs fairly. If AB allocates too much indirect cost to one product, the selling price may be set too high and demand could fall. If too little cost is allocated, the business may underestimate total costs and make less profit than expected. This could lead to poor pricing and decision making. As you can see here, we didn't have to write an entire essay. We had to write 3 to 4 sentences. That's it. So good job with this. In the next lesson, we're going to go over demand, supply, and price changes. I will see you there. Bye-bye.